Okay, good morning again, everyone. It is now my honor to present the two keynote speakers for today. The first is Antonio Weiss, counselor to Treasury Secretary Jack Lew. He will be followed by Governor Jay Powell of the Federal Reserve Board. After they each speak, we will gather back up here for me to have the chance to ask them a few questions, and then we'll give you in the audience a chance to ask your own questions. Both our speakers have had very distinguished careers combining the public and the private sectors. You can read the details in the bios that are provided out front, but I'm sure you'd rather hear them than hear me talk about them. So I'll leave it at that, except to say that it is a true honor to have them speak here today, and we are certainly grateful for their willingness to do so. So Antonio, let me give you the podium first.
Thank you, Doug. And let me also thank the previous panelists for talking about bond markets, but not Treasury bond markets. Jay and I are going to talk about Treasury bond markets, and my remarks are going to focus on market structure and the effects of technology. Now, as you may know, Treasury staff, working with the staff from the New York Fed, Federal Reserve Board, the SEC, the CFTC, recently released a report on volatility in the Treasury markets last October 15th. I would like to begin by acknowledging the teams at all 5 agencies for their hard work and close collaboration. The final report is the result of their rigorous analysis, and it really allows us for the first time to have a fact-based conversation about the events of that day and, importantly, the evolution of Treasury markets. Now, just to set the stage, as you all know, the Treasury market is the deepest and most liquid bond market in the world. There are over $12.5 trillion of marketable securities outstanding, and there are more than $500 billion of trades every day. Treasuries are the uncontested safe haven during periods of turbulence for investors all across the globe, and they're an essential element for primary and secondary market functioning and for so many other things. October 15th remains an anomaly, but our analysis of that day underscores the profound changes taking place in the structure of the Treasury market, and in particular, the effects of technology. Today, I will provide a short description of what happened on October 15th, and just remind everyone, probably no one here can forget it, and also discuss the factors that contributed to the volatility. I will then highlight some questions about market structure and suggest a preliminary framework for evaluating potential risks. Let's start with the events. As you all surely recall, that day was highly unusual. The 10-year yield experienced a 37 basis point swing, only to finish just 6 points lower, and there was a startling 16 basis point round trip during a 12-minute interval. There have been only 3 other days since 1998 when the 10-year has traded in such a wide range, and each resulted from an identifiable, significant monetary policy announcement. And there was nothing of the kind on or about October 15th. So as that day began, at 8:30 in the morning, September retail sales were released, and they were modestly below expectations. And ordinarily a miss of the magnitude, it was about 0.4%, would have driven yields down by maybe a couple of basis points. Instead, over the next hour, Treasury yields declined by 20 basis points. And then, at exactly 9:33 a.m., yields fell precipitously. Over the next 6 minutes, the 10-year yield dropped 16 basis points, only to retrace the entire move in the following 6 minutes. This 16 basis point round trip is what many have dubbed the flash rally, and what the report refers to as the event window. At that time, the head of one trading desk described conditions quite simply as panicked. In the days and weeks that followed, many explanations for what happened were put forward. Some suggested that an algorithm had misfired, or that a human trader had accidentally submitted an order to purchase a large number of treasuries. And others suggested, in fact, many others suggested, that algorithmic traders had simply shut off their machines. All of these suggestions, however, were speculative and, as it happens, inaccurate. At the time, no one, including official institutions, had examined detailed trade and order book data to test these hypotheses. The staff report, which I encourage all of you to read if you can, represents the most comprehensive study of trading in the U.S. Treasury markets since a 1992 report following the Salomon Brothers bidding scandal and a regulatory report to Congress that followed in 1998. So what did we find? We find that a confluence of events laid the groundwork for the volatility of that day. As confidence in the economic recovery improved earlier in 2014, bets that U.S. interest rates would rise had become popular. In fact, by the end of September, leveraged short positions in near-term interest rate futures had reached record levels. And there's a chart in the report that really shows how dramatic that buildup was. But instead of increasing, interest rates marched steadily lower. In the first 2 weeks of October, growth and deflation risks in the Eurozone, accompanied by uncertainty at that stage about the ECB response, generated real doubt on the part of investors about the prospects for global growth. The pessimistic tone of the IMF World Bank meetings the weekend just prior to October 15th exacerbated sentiment. Investors and the public at large were also concerned, and this was really the moment this was happening, about the unprecedented outbreak of Ebola and its potential consequences. So in response to all of these risks, investors turned to treasuries, the safe haven, driving up prices and lowering yields. Levered funds with record levels of short positions were obviously caught on the wrong side of this trade, and they began to unwind the bets. And as they did so, that obviously further compressed yields. Now, all of this set the stage for the initial volatility on October 15th, that first 20 basis point move. But really none of it, and the report is clear about this, none of it explains the timing nor the distinctive pattern of Treasury yields during the 12-minute interval. In those 12 minutes, trading volumes exploded, and market depth, defined here as the amount available for purchase or sale in the order book, collapsed. Volumes in the futures market surged to 9 times typical levels, and market depth thinned by up to 80%. Now, much of this trading was conducted by firms that engage almost exclusively in algorithmic trading, labeled principal trading firms, or PTFs, in the report. In other words, instead of turning off their machines en masse, as some had guessed, PTFs not only stayed in the market, but they increased both their level and the proportion of overall volume. And in fact, during the round trip in prices, PTFs accounted for 70 to 75% of total trading in both cash and futures, up from about 50% on normal days. At the same time, bank dealers responded to the extreme volatility by widening their bid-ask spreads, and at times they withdrew altogether from the offer side of the order book, and this was especially true in the first 6 minutes of the rally. Both PTFs and bank dealers responded entirely rationally in an economic sense on October 15th. It made total sense for PTFs, who want to avoid accumulating large intraday positions, to reduce order size, and equally it made total sense for bank dealers to increase bid-ask spreads to compensate them for the positions they take in the midst of volatility. But the result of these rational individual decisions was a dramatic reduction in overall market depth. So while prices moved at an extraordinary speed over those 12 minutes, price action remained continuous, and this was an important finding. Trading occurred all the way down in yield and then all the way back up. There were absolutely no gaps. Indeed, many PTFs with whom Treasury spoke, unlike traditional banker-dealers, noted that in their view, the market continued to function well throughout the day. It was not broken like the equity markets during the May 6, 2010 flash crash. So in addition to debunking the notion that PTFs turned off their machines, the analysis did not find any evidence of a fat finger mistake, i.e. an accidental large order, or a runaway algorithm. There was also no cascade of stop-loss orders, as is often the case with mini flash crashes in other markets. So what did happen and what was the cause? Well, from what we know, there was really no direct causal link between any one player and the activity we saw on October 15th. But a large part of the story of what happened between 9:33 and 9:45 a.m. appears to turn, to us, on the interaction at very high speeds of complex algorithms that generate massive amounts of trading activity at speeds far too fast for human beings to track. High-speed trading algorithms, which are employed by many bank dealers and by hedge funds, as well as by PTFs, appear to respond to an extraordinarily one-sided trading environment with far more willing buyers than sellers by generating a rapid rally in treasuries. And human traders took a few minutes to react. So one active market participant we spoke with contrasted this dynamic to trading in Boeing stock in mid-July of 2013. And what happened in mid-July of 2013 is that Boeing dropped suddenly by 7% because there was an unoccupied Dreamliner that caught fire at Heathrow. So in contrast, this market participant said, look, on October 15th, I needed to spend 5 minutes or so scanning news headlines, checking Twitter feeds, making a few phone calls, and only then was I able to confirm that there was no identifiable event. There was no fire in this case, and he was willing to step in. So the conclusions of the October 15th report were unsatisfying to some because we didn't uncover a single smoking gun. But as is often the case in complex systems, and certainly the Treasury markets are one complex system, it is difficult to reduce outcomes to simple causes. Moreover, the broader findings of the report were equally, if not more, significant. The evolution of Treasury markets, in particular cash markets, represents a fundamental technology-driven shift in market structure. Now, we have all been aware of this shift for some time, but the report has cast a brighter light on it and has given us the facts and figures to be able to see the extent of the shift. Algorithmic trading, as was discussed in the previous panel, was well established in equities and futures, and it's been that way since the late 1990s. It now accounts for a majority of trading in the most standardized liquid securities, including more than half of activity on interdealer platforms in cash Treasury markets. High-frequency trading, which is a subset of algorithmic trading, is applied in a number of strategies by a whole array of firms, ranging from owner-operated startups to large hedge funds and indeed bank dealers. It is quite simply a disruptive technology innovation, and it has reshaped the entire industry structure. It's exerted competitive pressure on traditional players by tightening pricing parameters, and it's created obvious informational advantages. As with any major technology disruption, there are risks and benefits. Now, the key for policymakers is to recognize that this technology is here to stay, and we need to be forward-thinking about its effects on market functioning. At Treasury, we're engaged with market participants, academics, policymakers to better understand this new market structure. And our view is that any policy proposals should be carefully tailored to address specific risks they're designed to address. So today I'll just share a few thoughts on 4 broad categories of risk that will help to guide our future inquiry: operational, oversight, fair dealing, and market resiliency. First, operational risk. Now, operational risk is, of course, inherent in any financial transaction, but the extraordinary speed and the automated nature of execution mean that this risk may be heightened in the case of high-frequency trading and the race for ever faster technology. The constant pursuit to save 1 more millisecond not only consumes resources potentially better deployed elsewhere, but it increases the pressure, as someone said in the last panel, on the plumbing of the system to handle ever-increasing speeds and message traffic. So we need to consider whether the race for speed at this already very advanced stage is helping or hurting market functioning. A second related category is oversight and risk management. Many of the large new entrants in Treasury markets are not subject to regular oversight and may not be sufficiently capitalized to withstand unexpected losses. Now, we all remember 2012 and the collapse of night trading, which had about 17% of equity markets. Now, that was a case where untested software wrought havoc in markets, and it put one of the largest trading firms out of business in a matter of hours. We need to assess how minimum standards are set for testing new systems and for introducing new algorithms. And there's the question equally of margin requirements, which in some cases may only be assessed a couple of times per day, sometimes more frequently. But they're not set at the speed of high-frequency trading, which sees trades executed in a fraction of a second. The third category might broadly be described as fair dealing. Now, while trading practices that are manipulative or fraudulent are not new to financial markets, automated trading may provide traders with additional tools to beat the system. The report discusses self-trading, which is simply where one legal entity is on both sides of a trade. Now, during the flash rally, the amount of self-trading was elevated, and this was especially so in the first half of the event window. Now, not all self-trading is illegal, and I want to be absolutely clear that I'm making no assumptions regarding the legality of the activity on that or any other day. But we do need to learn much more about the reasons for self-trading, and we have to consider whether there are benefits that outweigh the potential appearance of impropriety. Now, the Treasury Markets Practice Group, working with the New York Fed, adopted a revised set of best practices encouraging firms, quite simply, to submit bona fide offers and to avoid manipulative practices, such as submitting a barrage of orders to increase latency, in effect intentionally clogging the system, or submitting orders with the intent to cancel them before execution. Both practices are best practices are an important complement to regulatory oversight, but they are not universally adopted. Moreover, many participants, as I mentioned, in the Treasury market are not even required to register with regulatory authorities. So additional work is required to determine best practices and to identify and close regulatory gaps. The fourth category, and the broadest, is quite simply market resiliency. Perhaps the key question asked by the report is whether an improvement in average liquidity by certain metrics, not all, but an improvement, whether that improvement may have come at the cost of rare but severe bouts of volatility. Now, numerous factors are changing the way our markets function and the way liquidity is provided. The persistence of low bid-ask spreads on October 15th together with record volumes and a severe deterioration in market depth, may be an indication that we need to rethink and modernize how we think about liquidity and the metrics we apply. Underlying all of these issues, all of these questions, is the essential role of access to data and coordination across markets and agencies. The only readily available data are futures market transaction reports provided to the CFTC. Order book data are available on request by the CFTC. Information about activity in cash Treasury markets is not readily accessible, and authorities have virtually no visibility on dealer-to-customer activity, which by some estimates is over 40% of the market. Moreover, regulatory authority over Treasury cash and futures markets is highly fragmented, making cooperation essential, and the report was an example of effective cooperation, but also slowing response times considerably. Put simply, we cannot get the information we need to analyze risk across Treasury markets in anything that approaches real time, and that has to change. So in concluding, the report on October 15th and the work to follow, including today's discussion, represent an opportunity to undertake the most comprehensive review of the Treasury market since 1998, many years before algorithmic trading even began in Treasuries. Now, it's not clear what the end state for Treasury markets will be, and in this period of transition, policymakers and market participants have an opportunity to shape events, and we should learn from our experience in other markets as we do so. As we undertake this important work, we will be deliberate in our analysis, diligent in gathering the best ideas, and fact-based in our policy prescriptions. And policy should ideally be tailored to the specific risks we identify. But it's clear that the Treasury market is constantly evolving, and we need not only to keep pace with events, but also to plan and to plan wisely for the future. Thank you.
Let me too thank Doug and Martin for putting this together. It's great to be here today. I also enjoyed this morning's earlier panel, and had the unusual experience of nodding my head affirmatively and listening to all four of the panelists. So, my involvement with these markets, Treasury markets, goes back to the early 1990s when I served as Undersecretary for Finance. Some of you will recall the Solomon Brothers bidding scandal that broke in the summer of 1991. And that event required those of us with oversight responsibilities to do a thorough evaluation of the structure of the primary Treasury market, the auction market, and ultimately to propose a series of reforms which made their way into an interagency report that Antonio mentioned a little earlier, which we published in 1992. As part of that process, we also put together a public conference to consider further reforms to Treasury auction procedures with participation from regulators, academics, and the financial sector. And some of the ideas that came out of that conference eventually led to changes in the way that primary auctions were conducted, changes that I believe were beneficial to the integrity of the Treasury market. I'm thinking there particularly of the single price auction. Of course, the issues we're talking about today relate to the secondary market rather than to auctions. And although the Treasury market remains deep and resilient, there are nonetheless reasonable questions as to whether market functioning can be improved. The events of October 15th have been folded into a more general debate about market liquidity across markets. And I'll say that I take the concerns about a decline in market liquidity seriously. That said, it's hard evidence on the level of liquidity in secondary Treasury markets is mixed. There are some measures that are at or above pre-crisis levels, and some suggest a reduced ability to trade large positions without material price impact, which I would say is a reasonable definition of liquidity. And it's also possible that liquidity may be more prone to disappearing at times of stress. On October 15th, for example, market depth declined sharply, and we saw a sudden spike in prices that was without precedent for a period with little relevant news. Other events, like the 2013 taper tantrum, the Bund tantrum of last spring, and the sharp moves on March 18th in the euro-dollar exchange rate, all broadly show the same pattern: rapidly diminishing liquidity and large price moves for a given quantum of news. But the causes and implications of these events are unclear. Is this the new normal? It's important to simply say that we don't know. Current macroeconomic and market conditions are unprecedented in many respects. For now, what we have is a small number of broadly similar events that bear careful consideration. Most of these considerations apply across markets, but they're particularly important here in the Treasury market because of the crucial role Treasury securities play in the global financial system. As Antonio covered, in addition to serving the financing needs of the U.S. government, Treasury markets are important for the conduct of monetary policy. They serve as high-quality liquid assets for a wide range of financial institutions, including dealers in the Treasury market, and as collateral in countless transactions. Treasury securities are a global reserve asset, and Treasury markets are a key vehicle through which market participants manage their interest rate risk. The integrity and continued liquidity of the Treasury market affect nearly everyone. Treasury markets have undergone important changes over the years. The footprints of the major dealers who have long played the role of market makers are in several respects smaller than they were pre-crisis, and dealers cite a number of reasons for that change, including reductions in their own risk appetite and the effect of post-crisis regulations. At the same time, the Federal Reserve and foreign owners, about half of which are foreign central banks, have increased their ownership to over 2/3 of outstanding treasuries, up from 61% in 2004. Banks have also increased their holdings of treasuries to meet HQLA requirements. These holdings are less likely to turn over in the secondary market as the owners largely follow buy and hold strategies. But another change is the increased presence of asset managers, which now hold a bigger share of treasuries as well. Mutual fund investors in particular now beneficially own a larger share of treasuries, and they are accustomed to daily liquidity. Perhaps the most fundamental change in these markets is the move to electronic trading, which began in earnest about 15 years ago. And it is hard to overstate the transformation in these markets. Only 2 decades ago, the dealers who participated in primary treasury auctions, primary dealers, had to send personal representatives to the offices of the Federal Reserve Bank of New York to submit their bids on auction days. They dropped their paper bids into a box. The secondary market was a bit more advanced. There were electronic systems for posting interdealer quotes in the cash market, and the Globex platform had been introduced for futures. Still, most interdealer trades were conducted over the phone, and futures trading was conducted in the pit. Today, of course, these markets are almost fully electronic. Interdealer trading in the cash treasury market is conducted over the electronic trading platforms. And thanks to advances in telecommunications and computing, the speed of trading has increased at least 1 millionfold. Advances in computing and faster access to trading platforms have also allowed new types of firms and trading strategies to enter the market. Algorithmic and high-frequency trading firms deploy a wide and diverse range of strategies. In particular, the technologies and strategies that people associate with high-frequency trading are also regularly employed by broker-dealers, by hedge funds, and even by individual investors. Compared with the speed of trading 20 years ago, anyone can trade at high frequencies today. And so to me, this transformation is really more about technology than it's about any one particular type of firm. Given all these changes, we need to have a more nuanced discussion as to the state of the markets. And I would start by asking, are there important market failures that are not likely to self-correct? And if so, what are the causes, and what are the costs and benefits of market-led or regulatory responses? Some observers point to post-crisis regulation as a key factor that's driving any decline or change in the nature of liquidity. Although regulation had little to do, if anything, with the events of October 15th, I would agree that it may be one factor driving recent changes in market making. Requiring banks to hold much higher levels of capital and liquidity and to rely less on wholesale short-term debt has raised funding costs. Regulation has also raised the cost of funding inventories through the repo markets. Thus, regulation may have made market making less attractive to banks. But these same regulations have also materially lowered banks' probabilities of default and the chances that another financial crisis, like the last one, which severely constrained liquidity and did so much damage to our economy, will take place. These regulations are new, and we should be willing to learn from experience, but their basic goals, to make the core of the financial system safer and to reduce systemic risk, are appropriate and necessary. And we should be prepared to accept some increase in the cost of market making in order to meet those goals. And regulation is only one of the factors, and clearly not the dominant one, behind the evolution in market making. As we've seen, markets were undergoing dramatic change long before the financial crisis. Technological change has allowed new types of trading firms to act as market makers for a large and growing share of transactions, not just in equity and foreign exchange, but also in Treasury markets. As traditional dealers have lost market share, one way they've sought to remain competitive is by attempting to internalize their customer trades, essentially trying to create their own markets by finding matches between their customers who are seeking to buy and sell. Internalization allows these firms to capture more of the bid-ask spread, but it also may reduce liquidity in the public market. At the same time, it does not eliminate the need for a public market, where price discovery mainly occurs, as dealers have to place the orders they can't internalize into that market. So while the changes I've discussed are unlikely to simply go away, I believe that markets will adapt to them over time. In the meantime, we've got a responsibility to make sure that market and regulatory incentives appropriately encourage an evolution that will sustain market liquidity and functioning. In thinking about market incentives, one observer has noted that trading rules and structures have grown to matter critically as trading speeds have increased. In her words, and I'm quoting here, "At very fast speeds, only the market microstructure matters." Trading algorithms are simply a set of rules, after all, and they will necessarily interact with and optimize against the rules of trading platforms they operate on. If trading at nanoseconds, which are billionths of seconds, is taking place, there won't be a lot of fundamental news to trade on or much time to formulate views about the long-run value of an asset. Instead, trading at these speeds can become a game played against order books and the market rules. We can complain about certain trading practices in this environment, but if the market is structured to incentivize these practices, then we ought not be surprised when they occur. So the trading platforms in both the interdealer cash and futures markets are based on a central limit order book, in which quotes are executed based on price and the order they're posted. A central limit order book provides for continuous trading, but it also provides incentives to the fastest. A trader that is faster than the others in the market will be able to post and remove orders in reaction to changes in the order book before others can do so, earning profits by hitting out-of-date quotes and avoiding losses by making sure that the trader's own quotes are up to date. Technology and greater competition have led to lower costs in many areas of our economy, including the financial markets. At the same time, slower traders may be put at a disadvantage in this environment, which could cause them to withdraw from markets or seek other venues, thus fracturing liquidity. And one can certainly question how socially useful it is to build fiber optic or microwave networks just to trade at millionths or billionths of a second rather than thousandths of a second. The cost of these technologies, among other factors, may also be driving greater concentration in markets, which could threaten their resilience. And the type of internalization now done by dealers is really only profitable at large scale, and that too may have led to greater concentration. So a number of observers have suggested reforms for consideration. And let me be clear, I'm not recommending any of these, but merely noting the conversation that's going on and encouraging more. For example, some recent commentators propose frequent batch auctions as an alternative to the central limit order book and argue that this would lead to greater market liquidity. Others have argued that the current market structure may lead to greater volatility and suggested possible alterations designed to improve that situation. Questions about market structure also arise in funding markets for treasuries. As many have noted, there's a close link between funding liquidity and market liquidity. And for Treasury markets, the links to funding in the repo market are especially close. Post-crisis reforms have made the repo market safer, but also raised the cost of repo transactions. Greater use of central clearing could potentially lower these costs by allowing participants to net more of their transactions. And authorities have emphasized a greater use of clearing for a wide range of products, and I believe there could be benefits from central clearing of repo markets as well. There are several private proposals out there looking at that and trying to accomplish it, and any solution will have to satisfy some fairly demanding regulatory requirements. To wrap up, we need more clarity on the implications of structural changes in these critical markets for market liquidity and market functioning. This is a good time to hold another public conference to discuss Treasury market structure, in fact. And that is one of the recommendations in the October 15th report released last month. The conference will take place this fall. In fact, I'm just informed this morning that we've settled on dates October 20 and 21 at the Federal Reserve Bank of New York in cooperation with the Treasury Department, the Board of Governors, the SEC, and the CFTC. My hope and expectation is that the conference will bring market participants and regulators closer to an understanding of whether there are changes in trading and risk management practices, regulation, and market structure that could make our Treasury markets even more liquid and more resilient. Thanks very much.
Okay, thank you. And thank you both. I thought those were very interesting remarks on a very complex subject. Let me ask each of you a few questions before we go to the audience. So I'll do it in the same order as you spoke. Let me second your suggestion that the audience should read the interagency report if you haven't. It's a little dry, admittedly, but there's a lot of very good information.
There are pictures in the back.
There are pictures in the back. By the way, one of my recommendations would be to have them throughout the document. It would have been a lot more fun to read.
We discussed that.
But anyway, it is a very useful report because, as has been pointed out, we've lacked a lot of information about how the market works these days. But one thing you yourself noted, Antonio, was that it wasn't possible for you in a data-driven analysis to talk about the dealer interactions with their own customers, which is as much as 40% of the market. And I can respect your desire to only talk about what came from the data, but you must have also had discussions with the banks and the other dealers as to what their interactions were in general with their customers during that time period. Is there any color you can give us about what was going on at that level?
Well, I mean, as you say, Doug, we weren't able to get anywhere near the level of data that could be, BrokerTech and eSpeed were able to provide us with everything we needed to get to the same level in analysis in cash as in futures. And, we have nothing other than anecdotal sort of evidence for the rest of it. We don't actually even know that it's 40% of the market broker to customer. So that's just pure estimate. Could be higher, could be somewhat lower. Maybe people here have different views on that. We do know because we were calling around all day, and we generally were speaking with bank dealers, not algorithms. And those bank dealers said, look, this is the most stressed the environment has been since the financial crisis. And they did say that these were panicked conditions. And we do have that evidence, which I mentioned about a withdrawal on the offer side during the first 6 minutes of the spike. So it's possible there was a more severe withdrawal on that part. I should mention there were some anecdotes that we were completely unable to verify, and they may be apocryphal, that there were volumes that came from that market onto the interdealer market during the spike. And so I really would just circle back to what I said at the end, which is that we have to rethink, how officials receive data in all of these markets and the timeliness of the receipt of that data.
Okay, now, something that I found very interesting in the report was when you looked at principal trading firms, there were critical periods, in fact, I think probably both on the up and on the down, when one set of principal trading firms was effectively a provider of liquidity, and another set was essentially a consumer of liquidity as they took positions. If I can oversimplify, it sounds somewhat like there's a set of PTFs that are effectively taking market-making roles, and another set that are probably by and large momentum players that tend to be following the trends. I was wondering, did you get any sense of whether there were clear groupings of which of these firms were in which category, or am I being way oversimplified? Or
I mean, it's hard to talk about this without simplifying to some extent, but no, firms had both, passive and aggressive strategies, and so, the passive, the resting orders on both sides of the order book, were predominantly from PTFs, and the aggressive orders were also predominantly from PTFs. So really, throughout the spike, that 70 to 75% that we identified, PTFs were on both the passive and the aggressive side of things.
I guess what I was guessing, I'm just wondering if you have any sense of it, is that while there was some overlap, there were a set of PTFs that were mostly passive and a set that were mostly aggressive. Were you able to group them at all?
I mean, we do have more. We have aggregated the information we have, to preserve the data that we received. But I mean, I think what we can say is that it's just not possible to categorize individual firms on that basis. I mean, there are firms which describe themselves as primarily providing resting orders. There are other firms that describe themselves as doing both. It was very much of a mixed picture that day.
Okay, and if I can step back and kind of on behalf of the audience ask you a big picture question, and I think we'll bring it to Jay as well. It seems like there are two possible big picture theories here. One says, who the hell cares what happens in a 12-minute period if at the end of the day you're done with it? Does this mean anything? And then there's another way of looking at it, which says, if things can go that wrong for a 12-minute period, who knows what might be sparked in the future, and maybe this is tip of the iceberg and there are deeper problems. Do you have, what are your reactions to those theories? You think, as usual, the truth is kind of somewhere in between, or?
I mean, I think that the truth is that, this was a really, an awakening for market participants. It was something like 6 standard deviations from what anybody had seen. And so, no, we need to take it very seriously for all the reasons Jay described. I mean, treasuries, we fund the government with treasuries. Treasuries are a benchmark for pretty much every financing transaction. They're an integral part of pretty much every trade, high quality liquid asset. And so, no, we need to be vigilant about events like that. It did, of course, self-correct, but because it self-corrected the one time, you can't count on it self-correcting in some future date. And so we feel we have a lot of work to do to understand it. We remain confident in the markets. I mean, the markets are the most liquid in the world, and with the fewest anomalous events of this sort. But they're the most important market. They're our market.
So you think people should continue to buy treasuries? Is that your?
You said it, Doug.
Exactly. Jay, I know that was a rather amorphous question, but do you have any, could you give it your own views
Sure, I'll
about
take a
how
swing
much
at
this
it.
matters?
So I think it's important to take a step back and put it in context. So technology is evolving, firm risk appetite and risk management is evolving, the supply and demand of liquidity is evolving, and regulation is evolving, and they're all evolving at the same time. Markets are adapting to that at the same time. So you have to look at these events and ask whether they matter or not, which is kind of the sense of your question. Does it matter that for 12 minutes things did things that we couldn't really explain? So if it only happens once, maybe it doesn't matter so much. But the real question is there a pattern? And I just don't think we know. I think it's frustrating, but we don't really know. I think rates will be increasing over time. Presumably volatility, as we get away from the zero lower bound, volatility will return to more normal levels, just as an arithmetic matter. It'll be able to do that. And I think we'll be learning. And I think that's what we have to do is learn as this process goes on.
Okay, and question for you, Jay, and Antonio, you may want to chime in as well. I was very struck by, Jay, your explicit characterization and Antonio's implicit characterization that to some extent what happened was the first reactions were from algorithmic trading systems that by definition pretty much act on so-called technical information. And just to be clear, I mean that this is a term of art, meaning something that's based purely on price action and volume and things like that, rather than an attempt to determine more fundamentally, is the U.S. a better borrower at this point in time or a worse borrower, or will there be changes in the way the markets operate or whatever? Mostly like things like economic news. There may be some algorithmic trades that try to trade on fundamentals, but given how fast they trade, they can't really be doing very much of that because, as you pointed out, Jay, there's not a lot of new fundamental information each millisecond. Do you think, first of all, do you think that's a reasonable characterization? I presume you do, since I think I'm partly paraphrasing you. But to the extent that's true, is it a problem if we have a market increasingly dominated, at least in the short run, by technical analysis rather than an attempt to analyze underlying value?
So what I actually said in my remarks was that at very, very high speeds, for some traders, it can evolve into a game that's played against the order book and the market rules. It can, for some traders, become that. That doesn't mean, I think one of the takeaways from this excellent report, and I think, if I may say so, and from the reading that I've done, is that there are just many, many different strategies out there. I don't think, it's very hard to generalize about what algorithmic and high-frequency traders are doing. Certainly, they are doing things which are all about price discovery. Some of them are doing things that are all about market making. In fact, they're taking share from the more traditional market makers, who, by the way, are also operating with algorithms. So it's one of those areas where I think you have to really be very careful in drawing your conclusions. And I really didn't mean to be putting much of a value judgment in that part of my remarks.
No, and I'm sorry if I implied you were. I've designed technical trading systems for foreign exchange years ago, so this is something I've thought a lot about. There is a legitimate argument that while technical trading may kind of help smooth out markets, has some advantages, I personally would be a little worried if most of the trading out there ended up being on purely technical basis, not an attempt to see what the true underlying value was. So I was just curious if you had an opinion, but I don't want to press you on that. Any comments you might want to add, Antonio?
I agree with Jay's comments. There's been a large buildup in fundamental investing, and through the last 10 or 15 years, and record fixed income issuance, and much of that is in the hands of sovereign funds, long-dated liability managers, mutual funds invest on a fundamental basis, and so forth. So these are not mutually exclusive. Perhaps I could come back to also what you said earlier about, does it matter about the jump and so forth. I think what we need to be particularly focused on is prices that overshoot and don't self-correct, or price movements that create a lack of confidence in markets. And, that's what makes the work so urgent. I mean, if a price overshoots and doesn't autocorrect, and if that's in one of our major markets, then it's going to affect the cost of financing for some period of time in the real economy, and it's going to affect confidence in markets. So, much as this is a complex system, it's really on us to try to think through it, to think ahead. And, starting with treasuries seems to us foundational for further work.
Okay, and then one more question before I turn it to the audience. And I'll start with you, Jay, but Antonio, you can add thoughts if you want. Clearly, part of what this groundbreaking study has demonstrated is a very significant shift in market making away from banks and their affiliates and other traditional broker-dealers towards these principal trading firms as playing quite a similar role, effectively providing market making. What are the pros and cons of that shift?
So I think it's an empirical question, actually. It may be, I don't think you have an answer from sort of theory here. I think if algorithmic trading proves to be good at market making, that's fine. Of course, the question is whether the incentives and the nature and character of that liquidity are different, because there's no balance sheet there with high frequency traders. Whereas with the old traders, there was, and it still is, a balance sheet. There's a balance sheet. Now, admittedly, I would say, and the report says that they were sort of short and medium term liquidity providers, whereas the HFTs are really short term, just short term, as in very short term. Before you can't even blink your eyes that fast, in many cases. So, is it better or worse? I don't know. There may be room for both approaches. I think, as Antonio indicated, our job is to look ahead and ask, will this serve the public? Liquidity is a public good, just like safe and sound large financial institutions are a public good. The safety and soundness of them is, let's say. So I don't have again, I think it's an empirical question.
Antonio, any thoughts on the benefits and the costs of that shift?
Well, first, high-frequency trading is an activity, and it's an activity that's carried out by the PTFs we discuss, but also by some number of hedge funds and some number of bank dealers. I think what's interesting about the ones who predominantly trade high frequency is that they just operate on their own capital for the most part. The capital isn't much. They're relatively recent. We know far less about them than we know about the bank dealers and even the hedge funds. And I think I mentioned that there are these 4 areas of risk. I'm sure one could come up with more or categorize them differently. And but I think as we do this work, just as with anything, first, as I tried to mention, we don't need blunt instruments that act in a broad way, and don't address specific risks that concern us. And I think that the second point behind this that I should mention is that you don't make mass changes to complex systems rapidly. One of the aspects of this is that there's an opportunity for piloting. So Jay mentioned, for example, small batch auctions, and it is possible to pilot different policy ideas around high frequency trading and to get some initial results from it. But if something constitutes 50% plus of all standardized, securities, or it's headed to that, you don't make radical changes in an instant.
Fair enough. All right. Let's give the audience a chance. And again, as Martin was pointing out as well, please make sure you ask an actual question, if you could. And if you need a little prologue to that, please try to keep it relatively short. Please identify yourself and your institution if you're associated with an institution. Okay. Sir?
The first question is to Governor Powell. Your former colleague, Governor Jeremy Stein, has advocated for a tough love on the part of the monetary authorities. In plain English, he doesn't really believe that the Federal Reserve Bank and other central banks should incorporate what Councillor Weiss called panic conditions. I suppose my question to you, sir, is what is your stance on the proper parenting on the part of the monetary authorities? And assuming that you were for the Federal Reserve to incorporate financial conditions, what are the implications for the policy framework of the Fed?
Sorry, were you, just to make sure I understood you, you were asking about whether financial stability concerns should be incorporated into the making of monetary policy?
To some extent. In fact, if I were to go back to the presentation of Mr. Weiss, when we have a 5 sigma move in asset prices, which turn out to be noise, should the Fed be concerned about the noise in the market, and what are the implications for policy prescriptions?
So this could be another whole conference, and it's really
Excellent
not.
idea. Come on back.
No, look, the subject of how to think about financial stability in the context of monetary policy generally is too deep and broad to even attempt to answer in this context. I will though give you this. As monetary policy is normalized, it's reasonable to expect increases in volatility. If you look back at some of the events I talked about, the taper tantrum, the Bund tantrum, you don't really see much of a mark on the real economy. October 15th certainly was so quick it wouldn't have left a mark, but in fact, they don't seem to have had much effect on the real economy, and from that standpoint, wouldn't really play much of a role in the broader question.
Other questions?
Liaquat Ahmed, Brookings trustee. I want to ask a very broad question. Post-2008, there was this perception, in part because of testimony in front of Congress, that there was a fundamental conflict of interest between market makers and their clients. And, whether that was correct or not, that was the perception in the public. Then you get Michael Lewis's new book, Flash Boys. And I'm struck what a major bestseller it was. And the fundamental takeaway from that was that, high-frequency trading is sort of a form of institutionalized front-running, and that all the markets are stacked against, people, against individuals and final investors. How worried are you about this sort of growing sense of cynicism about the way major financial markets work?
I'll try. All right, take a swing. So, as Antonio indicated earlier, confidence in financial markets is absolutely critical. The loss of confidence was central to the financial crisis. So, people have to believe, and it has to be true, that the markets are honest and that people get a reasonable deal when they transact in the financial market. So, nothing could be more fundamental in financial regulation and finance generally than confidence. I have to say the story is way more complicated than the Flash Boys story. It's not just about sniping slowly moving traders at all. There's a lot going on. To take another swing at Doug's earlier question, the benefits of all this technology are more efficiency and narrower bid-ask spreads and things like that. So you get benefits from technology, as Antonio indicated. We need to be thinking ahead about how it's not going away, right? So we need to be thinking ahead about how technology can help. We can use technology to our benefits, and there are many, many different strategies going on out there. I don't think so. I think just echo your point. It's unfortunate when bad things happen that damage confidence, and we have to look out for those.
I would only add to that intermediaries are businesses. Investors generally are either investing for profit or investing on behalf of others for profit. And we want them to be businesses. And high-frequency trading firms are businesses. I think the question is, is our knowledge and understanding of high-frequency trading firms as a whole at the same level as our understanding of the other categories? And the answer is no. At the same time, we should not paint with a broad brush. I mean, I think there are a variety of firms, there are a variety of practices, there's a variety of practice around some of the risks that I identified. The way an algorithm is introduced, for example, varies, quite significantly from one firm to another. The way we preserve confidence is talking openly about these issues and not ignoring them. But it's not simple. And one should expect, Jay mentioned the 1992 report, and some of the regulatory oversight was done much later. But this will take time, and it should take time.
Okay. Martin?
This is a question about the impact of possible events in the real economy on financial markets and the current structure of financial markets. There's still some uncertainty about the Fed and when it's going to raise rates and how quickly, so that's sort of hanging over the market a little bit. And then the budget negotiations look awfully tough. The bills that are being reported out, I think mostly are going to be vetoed by the president, so we may have a shutdown, we may have a very difficult budget period coming up. Do you think the markets as we've described them, with mostly trading through algorithms, are they sort of in shape that they're going to be able to deal with this uncertainty, or is there concern that the changing structure of markets makes it harder to deal with that kind of uncertainty?
That's a complex question. I will say that I mentioned that there were 3 intraday moves that were larger than 37 basis points, and one of those was on the day that the United States was downgraded. And one hopes that Congress will do the right thing as we approach this next debt limit, because it does have the capacity to spook markets and to spook beyond just treasuries. This has been in place as a structure for several years. We've seen how it works, but it's precisely as we enter a period of more normalized interest rates and there is greater volatility, that we need to anticipate greater volatility and that we need to be thinking deeply about market structures. Part of the whole pitch and fever around this discussion of liquidity, and this is Jay's area and his colleagues, has also to do with a very simple reality that we're exiting, 7 years at the lower bound, and that does create a general anxiousness. And the way one has to think about it is that not all volatility is illiquidity. Some of it is price discovery. Now, price discovery today, with more electronic trading for the standardized products, is done differently than it was 10 or 15 years ago. It's done in smaller trades that are sequenced. But we don't know that that produces a worse result or a better result than the old method of price discovery. I mean, a large trade that you issue to your bank dealer, under the old system, you knew the price and you knew the total amount of the trade. And the new system, at least in some of the standardized securities, electronic, that'll be unbundled into a bunch of trades. That doesn't necessarily mean that the investor is getting a worse deal. So we're in this new environment. The fall or the next year or whenever it comes will induce more volatility, but we all need to be disciplined about distinguishing between volatility and illiquidity, because it always follows.
So I guess I would just add, markets are very difficult to predict in the short and medium term, and they will do things and overreact sometime and apparently underreact others, but not every market reaction has important implications for the real economy. So if you think about 2013, we had the fiscal cliff, We had the government shutdown. In the middle of that, we had the taper tantrum. And I challenge anyone to look back, for example, look at monthly payrolls for 2013, or GDP for that matter, and show me where the taper tantrum was. Show me where the government shutdown was. They didn't leave much of a mark, which isn't, so it isn't to say that markets won't react as interest rates rise. They very well may, but it's not clear that there will or won't be much of a reaction in the real economy.
Okay. I think there's somebody in the back. Sorry. I guess I don't see somebody. Alice, were you?
Alice Rivlin, Brookings. Let me turn Martin's question around, because he essentially said, if the Congress does something, Congress and the president really do something terribly stupid, will there be volatility in the markets? My question is, maybe there should be, how much volatility in the markets would it take to change, to get the attention of Congress and the president that maybe they're doing something really dumb? Back in '87, the stock market drop was widely thought to have precipitated concern with the budget deficit. There probably was no connection between the two, but it was nice to have something bad that happened in the markets that got attention.
That was a wonderful rhetorical question that contained its own answer. No, we're not wishing for a bad event in markets. We're wishing for, and we're not predicting markets, and we're not predicting how the fall will unfold. But I guess I would just say what I said earlier, which is that we expect, with respect to the debt limit, that Congress will do the right thing, and that it will not become complicated and hostage politically to other elements. So as to how the markets anticipate that, as to whether that creates volatility or not, in the past it has, at times it hasn't. And I think, as you said and as Jay said, at times volatility emerges for reasons that have absolutely nothing to do with political or economic events. And I think we're beginning to have a deeper understanding as to why that occurs.
Okay, on that, all right, Dennis, I'll give you, no, it's okay. I know Antonio has an important meeting to go to, but I think we have time probably for one more question. So, Dennis?
I was just going to say, it's like the noise in the signal, right? So Congress can often be the noise that doesn't impact the real economy. Of course, it could if it did something blindingly stupid, as Alice suggested they may have the ability to do. But it seems to me one of the bigger problems that we face is the slow erosion of confidence in our markets over time, apart from these particular things in Congress. And so while the markets may not be rigged, as somebody says or somebody doesn't say, and the impact of HFT may be good or it may be bad, it seems to me there's a lack of confidence that government officials, policymakers, and regulators actually know what's going on in the market. And while I think this is an absolutely terrific report, a great public service, and everybody should read it, one of the underlying concerns that screams out is the lack of information, never mind real time, even after the fact, that policymakers and regulators have about what's going on in the markets. And I think the problem with that is that, of course, it results in greater surprises more often. Surprises are what are going to kill confidence over time of investors and market participants. And so I wondered if both of you would comment. Were you surprised at the lack of data and information that you had real time, and even the lack of data information that you could get after the fact?
I was very surprised at how difficult it was to get the data, and I was surprised that the data that we didn't have. In fact, I thought at one point I was thinking that it might be possible to release the October 15th report on October 15th of the next year.
Antonio, do you want to add anything?
Dennis, you're confirming something I said at the end of my remarks, which is that we need better access to data across agencies, and we need something that approaches real-time access to data. We worked well and diligently and intensively, looked at billions of transaction data, order book information, but this needs to be more readily available to authorities.
Okay. Thank you both very much, and thank you all.